Great stuff. So the next chapter is on property income. Property income is interesting for a number of reasons. It is actually very clearly classified into a range of different types of property income, and that's what's the important bit when coming to talk about property income, not to mix them up at all. Sounds a bit like really. So the first bit of when we talk about property income is this very first bit we're going to talk about. So is it when we it says, of course, let's just look at the objectives: property business profits, furnish holiday lettings, rent a room, and the short premium on a short lease. Blah blah blah. Point is that we're going to talk about through each of these, and I might try and make them in separate videos. The first bit I'm going to talk about, the context that you have to think about, is that you bought a flat a number of years ago, or you bought a house a number of years ago, and you have moved out of that house and you're now married or something along those lines. That was the context in which this was designed for. But you've kept that property. Because you see, initially, property was never really meant to be and the type of asset you sort of just bought and built a portfolio around. Most people don't start off that way. It's more the case that they'd have a buy their first flat and then they'd move out of it into somewhere else, and then that triggers maybe building a portfolio. But typically, when this tax rule was designed for that, so you have a whole flat completely separate that you're renting out, and it's bringing you rental income, and if you like, property income, and that's the drive. So it's a whole entire house or flat. That's the first bit that we're going to look at. And over time, it's just been very arduous, because what used to happen was we used to treat it based on accrued income. It was just so annoying because you would have rent. We would say, okay, rent for the a month is 300 a month, and that would be 300 times 12. But then sometimes someone wouldn't be in there and you wouldn't be able to rent it out for 2 months. So what you would have to do is, first of all, recognize rent for 12 months, accrue it, and then take off, if you like, 2 months as a kind of bad debt or unpaid income. It was just all too complicated, especially just given the fact that we're just trying to record some rental income for a building that you have. Remember, you're an individual just walking around. You're employed. You just seem to have this house, this additional flat that you have some money coming in. And so, for the purposes of the exam, of course, when you're preparing a tax computation, it's still in that light of recognizing everything and then sort of deducting um, the periods that no one was there. But from an exam point of view, we treat everything on a cash basis. So you can see here, it says here that the property income assessed for an individual, and the tax year is income. Income less expenses, of course, arising in that tax year. Of course, it's to do with the tax years. Of course, we're dealing with individuals. You haven't formed a company or anything fancy. You're just going to work day to day, and you just seem to have this flat in the background. And what we do here is we do it based on a cash basis. So unless you're told to do it on an accrual basis, you do it on a cash basis. If you have more than one property, we just pretty much mix everything up together and just record all your income and deal with the expenses and do one return, if you like, or one calculation for property income. That's the point. So I wish to highlight again that the point is to use the cash basis. Literally means that what cash did you receive in that year. So if you rented your property for 7 months in the year and you received I don't know, 3 grand, that's what you record, 3 grand. You don't start saying I'm going to record it for 12 months and take off 5 months. Nothing fancy that way. Okay, and so therefore it means that we're pretty straight in terms of rental income received less rental expenses paid for that period, wholly and exclusively for that period. The other interesting bit around this is to do with the fact that it's what is between the 6th of April and the 5th of April. That's what we're interested in. Remember, it's like your salary. That's the period we're interested in. Um, okay, right. So in a way, it makes it slightly easier when coming to think about it and do our work. So here we are, an example. We have this gentleman, or I don't know, person called Hambury, owns a property, let for the first time on the 1st of July 2019. So I'm interested in what happens between the 1st of July 2019 and the 5th of April 2020. And it says the rent paid is 5,000 paid quarterly in advance. So I know what you're wanting to do there is think to yourself, so maybe what I should be doing is somewhat um, partition uh, creating a prepayment of income, if you like, because you're receiving the income. So it's a liability, if you like, at the end, if you like. But no, we just simply recognize that cash that was received, because the following year, you just, if you think about it, we're the ones who create this accrual issue. The following year, the person will just pay again. They might choose to pay less, doesn't really matter, but you just recognize what it is that you were paid. That's all you do. Um, and that's it. You just recognize that income. You don't, there's no accruing, there's no prepaymenting. Just recognize the cash, even though more was paid for that period. And then you just deduct your expenses. Again, you can see the reason why this shouldn't matter is really a question of materiality. The argument is that you're not receiving that much income, so it's quite immaterial. If you're beginning to receive a lot of income, then we're moving into company status. So you really should be forming a property company, and then of course we apply full-on accounting principles there. But this is just apparently meant to be a flat, so the adjustments shouldn't be much. Um, and there we are. So it says here that he paid, of course, December, great, and in May 2020 paid 400. But this 400 is May. Our financial year for individuals ends on the 5th of April 2020. So that's when we stop. So this 400 will not feature in our 2019-20 year. And that's why you have the figures looking like this. Right, great stuff. And so that's the first thing. Again, there's a standard rule. We'll come to see that. I mean, it tends to feature more in employment income, as sole traders, when dealing with sole traders who are running their businesses. But the argument is that I can imagine. I'm thankful both. I'm good to happy both of you in practice. I'm sure you've seen how individuals will try and put in sort of work that is to do with not to do with their house, or not to do with the business, but they'd maybe do some work in their own homes and try and slip in those invoices with work they're doing, if you like, say on their flats, if you like, so that they can put those through as allowable expenses. So their own homes are completely different. I mean, there's no way you can have that allowable or deductible, but they'll put those invoices together. I've seen that before. So really, the argument is that these costs that you're allowable expenses, must be wholly and exclusively for the business. Sorry, for the flat in question. And here are some examples: insurance, agent fees, repairs. This is important again here, really important. So once upon a time, all interest on loans to take out to either to buy or improve a residential flat, to let a non-residential flat, so you don't live there, but you take. So typically, then we now had this. Well, really, the reason why this has come in really and truly is because we now had the whole era of buy-to-let, whole industry that is beginning to calm down. Where people were taking out these interest-only mortgages, and therefore it was perfectly allowable, because interest was considered an expense, or is considered an expense, to allow that interest on that loan. But these were very high, because so to allow that interest as a full expense. But over the years, since 2017-18, the government has been gradually cutting down the full interest deductible as an expense by 25%. So it started off, you could always deduct 100% of the interest, and then it said you could only deduct 75, and you could only deduct 50. And as at your year end, you could only deduct 25% of that interest. So imagine you taking out a loan and you had interest of £1,000. You can only deduct 25% of that £1,000 as, so 250 as an expense. I'll talk about what you can do with the rest, the 75%. You can deduct the 75%. That's on that 750. You can deduct at the basic rate. You can use that as a relief, and we'll see an example of that at 20%. So the 750, 75% is not totally doomed. at basic rate, you can deduct it as a relief to reduce your tax rate, but you're no longer receiving this kind of full-on tax relief at your highest rate of tax, because right, if you're putting through the 250, that would reduce your overall high rate of tax. And that's what they're sort of showing here. What I was saying here, from since 2017-18, the that tax relief has been falling, and by 25% every single year up till so for 2019-20. So what does that mean for 2020-21? You will no longer be able to deduct any of your finance costs as a direct expense, but you will be able to get, if you like, 20% of those costs as a relief. You'll be able to get 20% of that interest costs as a relief from next year, but not this year. Your year is the last year where you can still get 25% as an allowable deduction. Yeah, so again here, we're really talking about a residential let property. You know, it's residential, you've let it out. It's and it's just really jumping into a question, really. I want to emphasize again, I say this is like I gave you context. The context is you used to live in this flat. So it's not like you have a flat that you're running as a business. It's not a business. You just have this one flat or two flats you've had. One flat, that's the context. So you can keep it very separate from, so it's not trading. It's not trading. It's just additional property income, if you like. So when we come to talk about trading, it's very different. Of course, if you're trading, yes, all interest is allowed as a deductible expense, but you are not trading or considered to be trading if you have the one flat sitting there. Okay, great stuff. So let's very quickly, before we take a break, let's look at this example here. So Adam owns a residential property that he lets out. During the tax year, he receives a rent of 15 grand and paid the following expenses: 1,513, and he has some other income. I'm not going to focus so much on the full. I just want to focus on the property income so you can see where we're going here. So in terms of property income, I'll come to the working here. Property income, that's the rent. These are all allowable, and like I said, he's only allowed 25% on that interest expense as a deductible expense. So 25% of the 7,500, you can see that here. Here's the 7,500, these are the interest costs. So that's the first thing. And therefore the property income is 9,325. And property income is non-savings income. So we just take that figure now, and now we can build our chart. He has trading income, property income, and some savings income. And we do what we've been doing so far. All of that. He's a higher rate taxpayer. 500 of that will get exempt because of the starting rate band. Starting nil rate band for higher rate earners. Put through personal allowance, deal with the bands as normal. It's just all non-savings income. But like I said, the other 75% of that, if you like, so that's the tax payable, but the other 75% of that interest will get relief at 20%. And that's how you get that relief to get your income tax liability. So we take the balance of the interest that he didn't get full relief for at basic rate, and have that and calculate that. And that's how we deal with that. Okay, great stuff. I'll see you in video in part 2.